August 2026 is a strange time for the Nasdaq. The underlying business fundamentals for tech companies are strong, but that momentum is slamming right into extreme market fragility and intense geopolitical tension. This split-screen chart shows the driving force on the left. Global AI capital expenditure is crossing $1 trillion this year, with hyperscalers alone spending over $800 billion on hardware. This spending is the primary driver for the 25% earnings growth expected in 2026. But the right side of the chart shows the friction. Tech valuations are at a 21 times price-to-earnings multiple, higher than 87% of the last 40 years. When you combine that price tag with sudden geopolitical shocks, you get these sharp, frequent spikes in market volatility. These PE ratios and VIX levels confirm that volatility is the baseline condition for the 2026 market. Participation requires accepting this turbulence as the price of admission, then choosing a mechanical strategy to manage the swings when they arrive. Right now, many retail investors are stuck. If you buy, you risk purchasing at a historic top right before a geopolitical pullback. But if you hold off, you risk missing the growth phase of this infrastructure build-out. Reacting to morning news headlines is rarely effective. Geopolitical events move faster than individual trades, and by the time you see the alert, the market has already adjusted the price. That is why Wall Street institutions generally move away from short-term market predictions. Instead, they rely on rigid, mechanical systems built around their specific operational time horizons. This leaves you with a choice. You can trade your personal time to actively extract value from this volatility, or you can trade a bit of daily liquidity for peace of mind and long-term compounding. To pick a strategy, you need to understand the internal mechanics of the QQQ. The Nasdaq 100 index uses a built-in rebalancing system to constantly rotate the largest non-financial companies to the top. In 2026, the index formally activated a fast entry rule. This allows newly public companies to enter the index immediately if they meet specific size and volume requirements, skipping the traditional waiting period. Look at SpaceX. Just weeks after its IPO in June 2026, it was added to the Nasdaq 100 and QQQ with a weighting of roughly 1.3%. This mechanism forces the index to rotate out stagnant companies. It captures high-valuation private firms as soon as they go public, ensuring the index holds the companies with the most significant market impact while they are still growing. Because QQQ is structurally forced to concentrate on these high-growth technology firms, investors have to navigate a much higher level of baseline volatility than they would in the broader S&P 500. If you have the time to monitor your portfolio every week, Playbook A, the active optimizer approach, is designed to put that volatility to work. In the top right of this quadrant chart is the active options strategy. It requires a higher time commitment but offers active downside protection. Currently, institutions are pricing in an expected weekly move of 1.3% to 5% for QQQ. The first tactic involves selling out-of-the-money put options at strike prices below the current trading level. By selling the put, you collect an immediate cash premium while waiting for a dip. If the market stays flat or rises, you keep the cash. If the market drops, you are assigned the shares at the discounted strike price. This strategy is capital intensive. You must hold enough raw cash in your account to purchase 100 shares of QQQ if the market drops below your selected strike price. For those who already own QQQ shares, the second tactic is executing covered calls. You agree to sell your 5 to 8% higher than today's value, with an expiration 30 to 45 days out. This generates an upfront premium. That cash provides a buffer that helps offset potential losses from sudden geopolitical events. The trade-off is that you cap your upside. If tech rallies aggressively on a positive earnings surprise and moves past your strike price, you will not participate in those peak profits. The active optimizer views the Nasdaq's 23.89% historical volatility as the raw material for their strategy. They use those price swings to generate consistent cash flow through premiums. If you prefer a low-maintenance approach that doesn't involve daily chart monitoring, Playbook B is the passive accumulator. Back on our quadrant chart, the bottom left shows the passive accumulator. For this path, we move from the standard QQQ to its more cost-efficient version, QQQM. QQQM holds the same companies as QQQ, but reduces the annual management fee from 0.20% down to 0.15%. This 10-year projection shows how that 0.05% difference compounds over time. While QQQM has slightly lower daily trading volume, the reduction in fees leads to significant capital savings over a 5 to 10-year horizon. The execution here is strict dollar cost averaging. You buy a set dollar amount on a rigid schedule and ignore the macro news cycle. This process removes the need to time the market, helping you avoid the stress of buying at a local peak. The trade-off is that you will inevitably buy during some expensive periods. You must be prepared to sit through routine 5 to 10% drawdowns without selling. You can supplement this by holding a 10 to 15% cash reserve. When the VIX index spikes during market panic, you manually deploy that cash to buy the dip. The downside is cash drag. That money sits idle and earns less during a sustained bull market. Playbook B is designed for long-term wealth accumulation with the lowest possible psychological and operational friction. Choosing a strategy depends on what you can actually execute. An optimized plan is worthless if you lack the time to manage it. This flowchart starts with the most important qualifier. Do you have time to monitor options pricing? If yes, your path is the harvester. Use covered calls and cash-secured puts. If no, your path is the accumulator. Automate QQQM dollar cost averaging and keep a 10% cash reserve. The 2026 institutional consensus focuses on a specific danger: missing the cumulative growth of this $1 trillion global investment in AI infrastructure. A 10% pullback is a short-term event, but the cost of sitting in cash during this expansion is much harder to recover. In this market, sticking to a strategy that fits your personal schedule and risk tolerance is more important than trying to outguess the daily headlines.